I know there's been thoughts, people talking about, well, I can retire on $1 million or I can retire on this set amount of money. That's not necessarily true anymore. It really is going to depend on your lifestyle, the lifestyle you want to lead in retirement. And we don't know. We don't know what the future holds. We don't know what the future brings, whether or not you might need more money or maybe even less money. Obviously, when you are retired, you don't have that steady income coming in. And so all the decisions that you make are magnified, because when you're still working and you make a bad financial decision, the hope is that you can make it back, right? You can, slow down your spending and your income is still coming in, and you can obviously save more, maybe expend a little less. But when you're in retirement and you have a situation where maybe a poor decision is made, something happened out of the blue, as we say, it's difficult to catch up, especially when you're pulling money out of your retirement savings. You're no longer bringing money in or adding to it. So I think seniors really feel the pressure. They feel as though if, let's say, the stock market, if they're investing in the stock market, were to go down, they don't have as much time to make up those losses. So all their decisions are a lot more magnified, and I think that is the anxiety or hesitation or fear that most seniors have. Well, I think the best thing to do, in my opinion, would be to overcompensate. If you think you're going to need a certain amount of money to retire on, a certain amount of income in retirement, perhaps budget for more than that. Try to make more than that. Obviously, we're going to try and make as much as we can when we invest. A lot of people, when they have a set amount, maybe they want to move that money into some sort of interest-bearing investment, so that their income, unfortunately, or their returns, unfortunately, will be a lot less, especially in today's markets with interest rates so low. Maybe you need to continue to invest in growthier type of investments for a little bit longer. I think that might be a wiser decision, or a wise decision to make. Obviously, people today, many people have RRSPs, Registered Retirement Savings Plans, and the government will force you to start to withdraw money in your 72nd year. So when you turn 71, you convert your account from an RRSP to what we call a RIF account, or Registered Income Fund, and then we start to draw money in your 72nd year. So the government will force you to do that. However, you could draw down on your RRSP anytime you want to. Obviously, there'll be tax implications with respect to that. Other accounts that you may have, a tax-free savings account, that's a really good one, because you can pull money out anytime and there are no tax implications. And then obviously you have just a regular investment account, Canadian or US investment account, US dollar account, in which case if you draw from those accounts, really it'll just depend on what you're selling to access the money, whether it's a capital gain you may have to pay tax on, whether it's interest income, dividend income. So those types of portfolios, just regular investment accounts, are not tax sheltered. So you're constantly paying taxes on the gains you make there. All these things should be addressed well before you reach age of retirement, to prepare for that day when you sail off into the sunset.